Today we are diving into this concept called RSI, or recursive self-improvement in the AI world. I'm your host, Billy Bob, and as always, I'm joined by our brilliant market analyst, Sarah. Sarah, can you break down what this actually means?
Hey, Billy Bob. I'm excited about today's show. We've got a fascinating topic that bridges cutting-edge AI technology with practical stock market analysis. Recursive self-improvement is this mind-blowing concept where an AI system can actually rewrite its own code, optimize its architecture, and improve its own decision-making processes. Think of it like a student who not only learns from textbooks, but can also rewrite the textbooks to make them better. Then learn from those improved textbooks and repeat the cycle over and over.
Wait, so you're saying the AI is literally improving itself without human intervention? That sounds like something out of a sci-fi movie.
It does sound like science fiction, but it's actually happening right now, especially with large language models. The AI identifies weaknesses in its own performance, writes new code to fix those weaknesses, tests the new code, deploys it, and then repeats the cycle. Each iteration makes it smarter and more capable. It's a compounding feedback loop of increasing intelligence.
That's incredible. So if an AI can do that for itself, here's the million-dollar question. Can we apply this same concept to investing in the stock market? Could an AI recursively improve its own trading strategies?
Great question, and the answer is yes, but with some major caveats. Let me paint the picture of what this could look like. Imagine an AI system that analyzes its own trading logs, identifies which strategies are underperforming, and then writes brand new code to replace them. It backtests the new strategies, deploys the winners, and repeats the cycle.
So it's constantly evolving its approach?
Exactly. It could invent entirely new technical indicators that no human has ever thought of. It could analyze millions of data combinations to find hidden signals in price action, volume, or even alternative data like satellite imagery of retail parking lots or GitHub commit frequency for tech companies. It could optimize its own execution algorithms to minimize slippage and hide its trading footprint.
That sounds like the holy grail of investing. So why isn't everyone doing this? If I had an AI that could do all that, I'd be printing money.
I wish it were that simple, Billy Bob. Here's where reality hits. The stock market is fundamentally different from, say, AI playing chess or Go. The market is what we call a complex adaptive system and an adversarial environment.
Break that down for us. What do you mean by adversarial?
So in chess, the rules never change. The board is always 8 by 8. The pieces move the same way. But in the stock market, your AI is competing against someone else's AI. If Fund A's AI discovers a highly profitable strategy, Fund B's AI will eventually notice that market anomaly and trade against it. This creates an evolutionary arms race rather than a unilateral singularity.
So as soon as one AI figures something out, the edge disappears because everyone else catches on?
Precisely. The alpha, that excess return, decays to zero because the market adapts. And there are other limitations too. Financial data is non-stationary, meaning the rules of the game change constantly due to macroeconomics, human psychology, and regulatory shifts.
Can you give us an example?
Sure. An AI might recursively optimize itself based on past performance and create incredibly complex code that perfectly predicts the 2008 financial crisis or the 2020 pandemic crash. But then it fails completely in a completely novel market regime because it's overfitted to the past. It's like studying for last year's exam instead of preparing for this year's test.
That makes sense. Are there other constraints?
Yes. Liquidity. An AI might discover a brilliant strategy that yields 500% returns, but it only works on $50,000 worth of volume. Once the AI tries to deploy $10 million into that strategy, its own buying and selling moves the price against it, what we call market impact, and it destroys the alpha. Compute and intelligence can scale infinitely, but market liquidity does not.
Wow, so there are real-world limits. Where do we stand today with this technology?
We're in what I'd call the proto-RSI phase. Quantitative hedge funds are already using genetic algorithms that breed trading strategies, neural architecture search where AI designs other AI models, and LLMs that write backtesting code and suggest parameter tweaks. But true autonomous recursive self-improvement? We're not quite there yet in finance.
Fascinating stuff, Sarah. So while AI can help, it's not a magic money machine.
Exactly. It's creating a hyper-accelerated evolutionary arms race where strategies are born, exploited, and rendered obsolete in milliseconds. The edge goes to those with the most compute, the cleanest data, and the lowest latency, not necessarily a single Oracle AI.
All right, let's pivot from AI to something our viewers can use right now. Sarah, I know you've been analyzing this business lifecycle framework, the one with the 6 stages from startup to decline. Can you walk us through that?
Of course. So this framework attempts to categorize businesses into 6 phases: startup, hypergrowth, self-funding, operating leverage, capital return, and a decline. The chart shows how revenue and profits typically move through these stages, with losses peaking early, break-even happening in stage 3, and profits maximized in stages 4 and 5 before declining.
It seems pretty straightforward, so what's the issue?
Well, the framework is directionally correct but incomplete. It's like looking at a car and only checking the speedometer. You're missing the fuel gauge, the engine temperature, the oil pressure, all critical indicators.
Okay, I'm intrigued. What's missing?
Let me hit the big ones. First, cash flow. The chart shows revenue and profits, but cash flow follows a different pattern and is often more critical for survival. During growth phases, cash flow is typically more negative than profits due to capital expenditures, working capital needs like inventory and receivables, and upfront investments.
So a company can show profits on paper but still run out of cash?
Exactly. That's why so many fast-growing companies go bankrupt. They're profitable on the income statement, but bleeding cash. Second, the framework ignores balance sheet strength, debt-to-equity ratios, liquidity, access to capital. Third, there's no mention of unit economics, especially crucial in stages 1 through 3. Customer acquisition cost, or CAC, lifetime value, or LTV, churn rates, contribution margins.
For our viewers who might not know, unit economics is basically whether each customer is profitable, right?
Precisely. If it costs you $100 to acquire a customer, but they only generate $80 in profit over their lifetime, you're building a business that scales losses, not profits. No amount of revenue growth fixes that.
That's a critical point. What else is missing?
Market dynamics, total addressable market, market share trajectory, competitive moat strength, quality of revenue. Is it recurring or one-time? How concentrated is it? Do they have pricing power? Operational metrics like employee productivity and capacity utilization. Capital efficiency metrics like return on invested capital, return on assets, return on equity.
That's a lot. So the framework is basically too simplistic?
It's a starting point, not the whole picture. And here's another issue. The framework doesn't address transition indicators. What are the leading indicators that signal a company is moving from one stage to another? What are the warning signs of premature decline? Some companies can skip decline entirely through reinvention. Think Apple in the late 90s or Microsoft under Satya Nadella.
Great point. So how do we fix this? How should investors actually analyze a business?
This is where it gets really practical. The key insight is this. The lifecycle stage is your analytical compass. It tells you which metrics to prioritize, which valuation methods to use, what risks to focus on, and how to interpret the data.
Can you give us a practical framework?
Absolutely. Here's a tiered approach. Step 1. Identify the business lifecycle stage using quick diagnostic questions. What's the revenue growth rate? Is the company profitable or burning cash? What's the market saturation level?
Okay, so I've identified the stage, then what?
Step 2. Apply stage-appropriate metrics. If you're looking at a stage 2 hypergrowth company, you're focused on revenue growth, hopefully 25% or more, CAC payback periods, LTV to CAC ratios, gross margins, and market share gains. Red flags would be declining growth rates, rising customer acquisition costs, or deteriorating unit economics.
And for a mature company?
For stage 4 or 5, you're looking at operating margins, return on equity, return on assets, free cash flow yield, revenue per employee. You want to see operating leverage and productivity. Red flags are margin compression and declining productivity.
So you're not using the same metrics for a startup that you'd use for an established dividend-paying company?
Exactly. And this is where many investors go wrong. They'll look at a hypergrowth SaaS company and say, oh no, it has no PE ratio. It's losing money. Well, of course it is. It's reinvesting every dollar to capture market share. Conversely, they'll see a stage 5 company with a low PE and think it's cheap, when it's actually a value trap about to enter decline.
That's a great point about context. What about the universal factors that apply regardless of stage?
Great question. Step 3 is layering on universal considerations. Regardless of stage, always assess balance sheet strength, debt levels, liquidity, access to capital, competitive positioning, moat strength, market share trends, competitive threats, management quality, capital allocation track record, alignment with shareholders, strategic clarity, and valuation, but it must be stage appropriate.
What do you mean by stage-appropriate valuation?
Early stage companies use revenue multiples EV to sales. Growth stage, PEG ratio, EV to EBITDA. Mature stage, PE, free cash flow yield, dividend discount models. Decline stage, asset-based valuation, liquidation value. You wouldn't value a biotech startup the same way you value Coca-Cola.
This is really practical stuff. I know our audience includes a lot of technical analysts. How does this fit with chart analysis?
Perfect segue to step 4. For your CMTs and technical analysts out there, you layer technical analysis on top of this fundamental framework. For stages 1 and 2, high growth, high volatility stocks, technical analysis helps with entry and exit timing. Focus on momentum indicators, volume patterns, relative strength.
And for mature companies?
For stages 5 and 6, technical analysis helps identify distribution patterns, breakdowns, and potential value traps. Support and resistance levels become more meaningful as stocks transition from growth to value. The chart patterns can confirm or contradict your fundamental thesis.
So it's not fundamental versus technical, it's fundamental and technical?
Exactly. They're complementary tools. The fundamentals tell you what to buy. The technicals help you with when to buy it.
I love that. So let's wrap this up with a practical example. Walk us through how you'd analyze a real company using this framework.
Let's say we're looking at a hypergrowth SaaS company, stage 2. Here's my checklist. Revenue growth. Let's say it's 40% year over year. Check. Net revenue retention, 120%, meaning existing customers are spending more each year. Check. LTV to CAC ratio of 4-to-1. Excellent. Gross margins of 75% and expanding. Check. Rule of 40. Growth rate plus free cash flow margin equals 45%. That's strong. Balance sheet has 3 years of runway at current burn rate. And technically, it's breaking out on volume after a consolidation pattern.
So that's a buy?
It's a strong candidate, yes. But notice what I didn't look at. PE ratio. Irrelevant because it's not profitable yet. Dividend yield, irrelevant because they're reinvesting all cash. Asset turnover, less relevant for an asset-light SaaS business.
And if that same company was in stage 5?
Totally different analysis. I'd be looking at free cash flow yield, dividend sustainability, debt levels, return on invested capital, and whether management is allocating capital wisely through buybacks or dividends. The metrics completely change based on the life cycle stage.
That's the key takeaway, isn't it? Context is everything.
Exactly. A stage 2 company with bad PE ratios might be excellent, while a stage 5 company with good PE might be a value trap. The life cycle stage is your analytical compass. It tells you where you are, what to focus on, and what to ignore.
Sarah, this has been incredibly insightful. So, to summarize for our viewers, RSI in AI is real but has limitations in markets. Business life cycle frameworks are useful but incomplete. And the key to smart investing is matching your analytical tools to where the company actually is in its journey.
Nailed it, Billy Bob.
All right, wealth builders, that's a wrap for today's episode. If you found this valuable, smash that like button, subscribe to Build Wealth Now News, and hit the notification bell so you never miss an episode. Drop a comment below telling us what stage your favorite stock is in and what metrics you're watching. Sarah and I read every comment.
And if you want deeper dives into specific stocks or sectors, let us know in the comments. We're here to help you build real, lasting wealth.
Until next time, keep building that wealth, stay disciplined, and remember, the best investment you can make is in your own financial education. See you in the next one.
Bye, everyone.
Build Wealth Now News is dedicated to research the businesses behind the stock names. Our research are done with artificial intelligence assistance using the best practices in the industry. Please note that investing carries its own risk and you should do your own research before committing any stock to your own portfolio. This conversation is for educational and entertainment purposes only.